Welcome back, everyone. My name is Michael LeBlanc, Senior Portfolio Manager at Canaccord Genuity Wealth Management, and thanks for joining us again this week, where we talk about everything that goes on in the markets that's affecting the economy. Obviously, we're going to talk a lot more about what's going on in Ukraine and how that's affecting things. And of course, the theme for the last couple of years, inflation and interest rates. But with that, as always, let's take a moment to remind everyone that everything we do cover on here is for information purposes only. Always do your own due diligence or reach out to us. Go to mikeonmoney.com. We have all our other content there you can look at, or give us a call, fire us an email. Happy to discuss any particular situation or strategy that might be appropriate or effective in your portfolios. So with that, as always, we touch a bit on COVID-19. I'm not going to spend a lot of time this week on it. Obviously, its impact on the markets and the economy have been dwindling, although we still are suffering a lot of the kind of carryover from the pandemic closures, supply chain issues, and of course the driving up of inflation, in which is really driving the markets in 2022. But we'll address those under independent effects. Really nothing more to talk about, from last week. Just seem like the restrictions are unwinding more and more. There is some pockets of resurgence in the number of cases, but hospitalizations stay low. So things move on until we hear anything different or any changes on that front. Pretty much becoming less and less of our future outlook when we talk about the economy or the markets. So with that, let's take a look at what's going on this week. We are looking at the home price index for January is going to be coming out, and the consumer confidence for March numbers are coming out. So we'll have a close eye on that. We have actually started to see, and this is pockets, so this is not a general trend yet. We don't have the data on that, but we have started to see some weakness in the housing prices. And when I say weakness, I just mean, we were in a state of frenzy. Basically, you list your house, you get whatever, a dozen or more offers all above asking price, and it's sold the next day. We're starting to see cases where we've seen a few sales below asking price and not getting those multiple offers, maybe only one offer coming in. So is that a trend that's going to pick up, or is it just kind of, local, the local trend where we've seen, one spot here, one spot there? We have seen some in Toronto and some in Vancouver, where the pricing markets exist, start to show those signs. So we're going to keep a close eye on this. Obviously, the numbers coming out for March will be an indication of what might be happening on that front. We have seen interest rates move up quite a bit, so that could be having an impact on buyers' decisions. Stock futures are just a little bit higher again, as bond yields edge closer to kind of the flash and signal of potential recession. We'll talk a little bit about the bond yields, but the stock futures are starting to show some indication of a slower growth and with higher interest rates. We've talked about that. More and more we're starting to see different calls for possible Q2 recession in the markets. Probability is starting to increase on a regular basis. I'd say in January, it was an early call by a couple of places. We started to get a lot more nervous early February, kind of before the war, that the potential was increasing quite dramatically. And now more and more trends, even when we talk about interest rates, we're going to look at the yield curve is starting to invert. Futures are starting to indicate a slower growth or negative growth for a period of time. Again, so far, it is looking like if we do go into that recession territory, it will be brief, but we might actually get there in Q2. So we'll keep a close eye on those things. Investors are really, of course, monitoring the peace talks between Russia and Ukraine, which resumed today in Istanbul for the first time in 2 weeks. So, the markets have laxed a little bit today, or starting to feel a little bit better today, as those showed signs of potential positivity. We've been bullish on those talks before, and then things kind of ended badly. So we'll have to keep a look to see what kind of news comes out of there. And Europe rose, led by 1%. Europe's index rose by about 1%, led mostly by automakers. Barclays fell by about 4% for a second day after they admitted to a debt sale mistake that's going to cost them or could cost them almost $600 million. So they're taking a hit a bit on earnings, but overall, as I said, the sentiment is a little bit more positive today on those new Russian-Ukraine talks happening. A U.S. Treasury yield curve starting to diverge and send mixed signals of recession. So this has been the call, as I mentioned, since January, that if we go into this inverted yield curve, we could go into negative growth for, if you go 3 months in negative growth, you are in a recession. So starting to show more and more signs that we could get there. Now, again, the call for this recession would be a short one. It could very well be a situation that you don't know you're in a recession until you're out of it, because the way a recession is technically defined is 3 months of negative growth. So if it is a short recession, we could be coming out of it just in the 3rd month of negative growth and then be out of it by the 4th. So when you actually make the official call of a recession, you've actually come through it. So again, we're starting to see more and more of those signals kind of triggering that more opinion that we're headed towards a recession. Funds are flocking back to the curve after it flattened after the Fed did do their interest rate hike of 0.25%. Now, again, they did do that 0.25% hike, but they've also signaled pretty much the next one's going to be at least 0.5%. The market kind of shrugged that off, more on positivity out of the Ukraine-Russia situation, but it is still there. Remember, the underlying theme is inflation, interest rates this year. There is other things affecting it, a war, but that underlying theme still exists, and we have to work our way through that. So the Fed has indicated likely 0.5% for the next hike. So if we do see that, do expect more volatility in the market, pretty much across the board. Biden's budget, he's just rolling out his budget, putting a big boost in military spending. In fact, I think it's one of the record largest military spending increase during peacetime, looking for about $5.79 trillion to build up their reserves, their fleets, their equipment, in case something happens in the future. And we're seeing this in a lot of countries around the world. Germany's done the same. Canada's talking about doing the same. Canada's put out interest in bids for the Lockheed F-35 jet to update our Air Force. So more and more countries are spending more money on defense, as the concern, not just what's happening in the Ukraine, but that there could be more challenges down the road, and they want to be prepared. U.S. trade deficit narrows in February, but still record high. But we have seen it come off the high in January, so that is that trend. See that trend continue, because those large numbers continue to weigh on the economic growth of the first quarter, and again going into second quarter, could we see negative growth? OPEC plus is set to increase slightly the output of oil and gas around the world, despite what's happening in Ukraine. They're not really looking on turning on the taps completely. So again, we don't expect oil prices to come off their highs that much. In fact, probably still a strong trend for oil as we go into May and June. Keep in mind, oil production is a bit like turning a ship. It's not something you can just turn the tap on, turn the tap off. It takes time. So when they're looking at supply increases or supply decreases, they have to really take a longer term approach. And obviously like having the price stronger, because that means bigger profits for them. But we probably won't see them really increase the output, in short order. It's going to be a longer trend that we have to play on the energy front. U.S. moles shaking up the stock trading rules to aid small investors. So this has been an ongoing challenge. I mean, in the last couple of years, we saw the power of the small investor with the Reddit stocks, so the internet trading around things like GameStop, which continues today, and we're still seeing some different plays in there. And the U.S. is looking at their rules, their trading rules, to see if they can't make it a little bit more transparent and easier for smaller investors to have same access as institutional investors. So we'll see where that comes from. It's not going to be anything that's going to happen overnight, so we'll keep a close eye around any new information on that front. U.S. Treasury is also proposing a new plan to enforce the 15% global minimum corporate tax. So part of that budget that Biden put out there to boost military spending was also to have a minimum tax on kind of the billionaires or the elite around the world. And in the last year, 136 countries came together to look at putting a global minimum tax into place, basically saying to try to stop the parking of cash in non-taxed or very low tax jurisdictions on the global front. We've seen some corporations do that, where they'll set up a company in a low tax or no tax jurisdiction, even though the primary sales or the primary revenue is being generated in, say, the US or Canada or anywhere in the world, and then avoiding or at least minimizing a lot of their tax bills. So countries around the world have come together to say, no, it doesn't matter where your revenues come or where you're located, there is going to be a minimum tax. So there's more push to get that into place, especially as more spending in the US and around the world continues to rise. Let's take a look at what we see coming up this week. The Labor Department's looking to see what the monthly job openings and turnovers were. We're expecting the job openings to have dropped a bit from February, although February's 11 million was a big number. As we see that trend kind of not reversing, but certainly plateauing a bit and slowing down. Separately, we're looking at the Consumer Confidence Index, likely to have dipped in March as people get more and more nervous, especially with the war going on. Very likely we're going to see that start to pull back. And in fact, when we look at things like the VIX, which is the volatility index, we're seeing more and more indications that people are getting concerned and that we're headed towards that possible recession. Memory chip maker Micron Technology expected to report they're probably near doubling in the second quarter net income, boosted by lower cost and obviously huge demand for chips for computer electronics and everywhere where we use them. But I would still say look out on the supply chain logistic hurdles that chip manufacturers are going to be facing with the Ukraine-Russia crisis, because again, a lot of the raw material, all the supply is coming out of that area that was feeding into their manufacturing. So we're very likely to see a push up on their costs, their supply costs, and logistics to get their product out to market. So we'll keep an eye on that. Just not just Micron, but all the chip manufacturers. On the U.S. front, Tesla is going to seek shareholder approval for a stock split. So we saw the shares surge. Obviously, stock splits, markets generally like stock splits, and they're seeking approval to increase its number of shares and enable a stock split to form a broader liquid company and start to provide dividends as they continue to mature as a company and the revenue start to stabilize more. So that's driving the price up. We've seen this in the past. Apple's done it many times. Google's got one planned for July. The list goes on, but probably we'll see shareholder approval and we'll see that go through. The important thing at this point is to see where the stock price settles pre-split, because usually what they're looking for is a bump up after the split happens as well. Deal on the rules forcing tech giants to police content is possible in April. So this follows, we've been following this trend. The EU tends to be a bit of a trendsetter when it comes to or standard setter, I should say, when it comes to kind of antitrust rules or technology rules around policy. And the rest of the world tends to follow suit afterwards. And this has been going on for a while in the EU. They've been really looking pretty hard on this at the tech giants out there. Obviously, there's the misinformation issues out there. There's age issues, and also the different hate speech and content on their platforms. And they all have their own way of monitoring. They have their own internal policies of policing that or managing that. But the EU is looking at putting out a broad countrywide or continent-wide set of rules for those platforms to make them responsible for managing the content to a certain standard. So that could mean legal repercussions if they don't have in place proper monitoring of content and postings. But we're going to have to see what that looks like. Obviously, that will impact the cost of operating in that jurisdiction, but also in the broader jurisdictions. As I said, most countries tend to follow the EU standards once they're accepted. Apple's looking to cut iPhone and AirPods output as Apple is seeing a slowdown caused by the war. Production cycles are being interrupted. The more pessimistic outlook of your consumer buyers are spending less and less as, again, those concerns of possible recession continue to build. HP is seeking to ride hybrid work boom by buying a $1.1 billion company called Poly. Poly is a video device maker that a lot of the stuff goes into the technology around the hybrid work and hybrid technologies. They're looking to expand that out as we see more and more shift into hybrid technology across all markets. E-commerce unit, a unit of Shopee, to shut down India operations. So this is the gaming firm C, said to withdraw from India's retail market just months after starting their operations there. It's the second pullback actually they've done in a month in overseas expansion, as they quickly started to see a lot of losses in breaking into these markets, and they just don't see the strong growth for the next year to really sustain them through those loss periods in order to turn into profitabilities. So again, that weaker growth outlook is going to start to affect the growth and expansion of companies. So if you're invested in any industry, it's really important at this point in the cycle of the market is to not look so much at the past numbers, but really start to look to see if those numbers are repeatable. Right, we saw a lot of growth in 2021. We already saw some pullbacks in some companies going into 2022. But as we see their numbers, their profitability numbers come out, we really have to look at what the source of that growth or expansion was, and is that going to be repeatable? Is it going to be under pressure this year? Because there are a lot of factors at play. As we mentioned, we still have the supply chain, we have inflation impacting, we have slowing economies that could really impact things. So just be really conscious of research reports that are only looking at, hey, here was the numbers for 2021. It looks great. It might not necessarily be that strong of outlook for 2022, depending on the sector, depending on the company, and depending on how these different things might impact them. On the currency front, we saw the euro struggle a bit to climb, to climb or hold sustainably above a 110 US dollar. Obviously, some positive news out of the negotiations with Ukraine and Russia are holding them in there, but we probably see a bit of weakness if those fall apart. The ruble did rise to a 4-week high versus the US dollar in hopes that there's some sort of breakthrough talk, but we'll have to see again how that plays out. As we mentioned on the bond market, investors are keeping a very close eye on the bond market. However, as we said, those predicting signs of a potential recession are really starting to show themselves. And the bond market tends to be the one that sees it first. So the bonds future markets tend to pick up on recessionary trends before the equity market. So keeping a very close eye on that. They are trending more and more towards that yield inversion or the curve inversion, and if we go there, as I said, it's kind of looking like second quarter. On the commodity front, oil price edged a bit higher again. It's holding in there really strong. We're seeing some fluctuation kind of between 103 and 110. Broke through the 110 briefly last week, coming back off a little bit. Gold fell a bit this morning in the European sessions, about $35 an ounce, bouncing back up again a little by just before I started the session, but still holding in strong. We are seeing a little bit of sell-off again. Just it spiked up on the war, so we'll see a little bit of weakness as the optimism that there could be some positivity out of those talks. But keep in mind that the longer trend, going back to what are we looking at for 2022? It's inflation and interest rates that still signals a longer strength in the gold market. So we're not giving up on gold. Just like energy, we see a little bit of volatility on the short-term outlook of the war. But the longer term outlook of inflation and interest rates, the long-term trend is still there. So keep that in mind when you're buying the dip, selling the highs. Not to say you should be out there day trading or trying to guess or time the market. But if you are looking at stepping your foot in, you see a pullback, those are the days to wade your toe in. Looking at that longer trend of strength that we'll likely see through 2022. So with that, that's all I have for us this week. Again, if you have any specific questions, please reach out, mikeonmoney.com. Happy to answer any questions. We'll be back again live next Tuesday. For this, you can also catch the replay on YouTube and our podcast on Spotify or Apple. And if you want to catch any of our previous updates, feel free to go there. But as always, have yourself a great week and look forward to talking to you next week. Thanks, everyone. Bye.